Hey, YouTube family, welcome to another Kevin Strong show. And in this video, we're going to talk about how rate cuts won't help. We're going to go over a chart that I talked about a few weeks ago. It's a 100-year chart based on the Dow Jones Industrial Average. We're going to go over that. We're also going to talk about a graph that talks about how the Fed underestimates the increase in unemployment. And last but not least, we're going to do some stock stuff. I want to kind of get back on track with that and share with you guys what I haven't shared with you in a long time is that simulation trading. Remember back in March, I was doing that and they give you a dummy account, but you can make live trades, but it's with paper money. And that account started at $200,000 5 months ago. I'm going to give you an update because I haven't done that in a while and talk a little bit about that. So if you're new to the show, once again, welcome. Consider subscribing, hitting the bell notification, and liking the video. So without further ado, the first thing we're going to do is slide over to this article and look at this chart. Those of you who have been following me have seen this chart before, but it warrants a second conversation. So as I said earlier, this chart deals with the Dow Jones Industrial Average 100-year historical chart. For those who've seen this before, welcome back. For those who are watching this video and haven't seen this chart before, these vertical gray bars indicate recession. So the point in explaining this again is talking about how I think the Dow Jones Industrial Average has peaked. I think the all-time high is in. I think the NASDAQ is currently experiencing some pullback. It's going to rebound going up into the election or shortly thereafter. But I think the all-time high for the NASDAQ is in. However, I do think there's a plausible probability that the S&P will reach an all-time high by the end of this year. So it was the famous late, great Meatloaf used to say, 2 out of 3 ain't bad. So let's go ahead and take a look at this, ladies and gents. I'm not going to go all the way back, but you'll get an understanding of what I'm talking about. We're going to go back here once again to the great financial crisis around 2008. As you can see at this point in time in history, the stock market, the Dow Jones Industrial Average, was a little bit over 18,000. This was in 2008. So if you bought at the peak because you listened to your financial planner who comes into the office that has a pair of shoes on from Payless, that's worth about $20, and they keep telling everybody you can't time the market. Well, you can't, but if you understand swing trading, and some other basic trading principles, you can get a pretty good indication when things are going to roll over or start to trend up. You can't time it exactly, but you can definitely get some tell signals. It doesn't take a rocket scientist to give you an analogy. You look up in the sky and it's getting kind of cloudy and you say, hey, I might want to grab an umbrella just in case. But I digress. So we're at February 2008. We're at a little bit above 18,000. And if you bought at the peak right before the great financial crisis tanked, how long did it take for you to get your money back? And I'm going to bring this over here. We're going to say around 2013. Okay, so that's roughly 5 years. What's interesting about this period in time between 2008 and 2013 is that during that period, the Fed lowered the Fed's fund rate to 0. So we weren't dealing with a lot of inflation. That's why we were able to keep the Fed funds rate so low for so long, because there was no inflationary pressure being put on the Fed funds rate. We won't be able to do that this go around, in my humble opinion, because I think we're looking at up and down and possibly stagflation at least for the next 7 years. But getting back to this example, from 2008 to 2013, it took 5 years to get your money back, and you still have to factor in some inflation. So that could have easily be another 1 or 2 years when you figure it. We all know what happened during the healthcare crisis back in 2020. And in December of 2021, the Dow peaked at around almost $41,000. We're in 2024. As I speak right now, the Dow just closed at 40,000. So even if you bought at the peak in 2021, and held, and you bought at that level, you're no better off today than when you were almost 3 years ago. And we all know we have seen an exorbitant amount of inflation hit every aspect of our life and society. Once again, this is why I think it's incumbent upon any low, middle, and upper class. All people should understand how to basically manage their money, understand some fundamental principles of the stock market. What I like about it, the only barrier to entry is knowledge. It doesn't care if you're white, if you're black, if you're straight, if you're gay, if you're a convicted felon. None of that stuff matters. Only thing you need to do is have the knowledge to be able to know when to click the buy button and know when to sell. And that's it. So this is going to be very interesting because what I think is going to happen is I think as we see right here, we're already at a double top. I think the all-time high for the Dow Jones Industrial Average is already baked in the cake, so to speak. And this is going to start to roll down. We might get some volatility up and down. We might get a little bit of a what they call an exuberant push right after the election. Regardless how you feel about that, you fill in the blank. I'm just here to make money. I don't care about politics. But at the end of the day, I don't think whatever happens is going to reach an all-time high, and it's going to pull down in 2025 as we enter a deep, wide recession and potentially a quasi-depression. If that turns out to be a reality, I think the downward trend, the downward pressure, when that starts to happen, is going to be way more violent than what we've seen during the great financial crisis. Because you see here, once again, the gray bar indicates recession. You're going to see a massive, massive drawdown. And I think there's the potential for that to happen again. The Feds are going to cut rates. The benefit of that from a consumer standpoint is that things like mortgages and credit cards will get a little bit more of a relief from an interest rate standpoint. However, as the commercial banking industry starts to get hit with a lot of commercial bad loans, lending in general, not only in the commercial space, but in the residential space as well, is going to start to tighten. So be careful what you wish for, because I think as the Fed continues to cut rate, lending standards are going to go up, credit is going to go down, and it's going to become a very tight environment to borrow. Not to mention, I think unemployment is going to go up quite a bit in 2025 and beyond. So now we're going to go over a chart that talks about what happens to the stock market after the Fed cuts rates. And then we're going to look at some things that the Fed has underestimated when it comes to coming up with projecting unemployment numbers. And let's see, we go ahead and pull this up here, and we're going to go about the rate cuts. Okay, so I'm going to give my mouse a moment to adjust. Looks like it has done that. So what we're looking at here, ladies and gentlemen, is that stock market valuation and performance after the Fed's first rate cut. So now we've got some historical data to look at to determine what happens with the stock market, or particularly the S&P 500, which is the benchmark for most people. From 1974, as you can see over here to the left of where my mouse is at, all the way up to 2019. So the way you look at this chart, we're going to go from left to right, and I'm going to go down here kind of quickly. But to make a long story short, the S&P ratio on the first rate cut. Okay. And then next to that is the market low date. So the number of days from the first cut to the market low date, you get the number 94. So from January 1 to 1974 to October 3rd of 1974 is 94 days. 8.7 on average. You can see the decline when it's low as 27.6, and then 6 months after the first cut was 18.2. 1980, 26 positive, negative, positive, positive, positive. This is what's interesting. Now we're going to focus back in 2001 during the tech, I think that was the tech bubble, was in 2020. The S&P decline low was at 42, and then 6 months later went down to 7.7. During the great financial crisis, big drawdown, 55%. 5%. Only got 15% of that back 6 months later. So there's a 40% gap. August 1 of 2019, 24.2. It was positive 10.3. Those of you who follow the economic history of this, we all know what happened during the beginning of 2020 when the healthcare crisis came in, and then what happened? All of this went down. So this data is incomplete. This is a massive, massive drawdown if this was to go out a couple more years, because we didn't really start to rebound until the Fed started, changing rates a little bit after that to stimulate the economy, not to mention quantitative easing. So they come up with an average of the S&P decline to the low was negative 20.5%. And then 6 months after the first rate cut, they're saying it's 3.4. But like I said, this does not take into account the health care crisis. So this number is much, much, much lower. So this is just a short example looking at a historical perspective to let you know that when you buy at the top, or when you start to buy, generally speaking, when the Fed starts to cut rates, that's typically a time to get defensive. This is not financial advice, but utilities, maybe the bond market, gold, silver. You even have to be careful with that, because there's periods within the first stages of a recession that commodities could possibly pull back before they ultimately go a lot higher. The second graph is going to be really quick, dirty, and easy. The light blue is basically the Fed's projection of change in unemployment rate. And the darker blue is actual change in unemployment, the actual change in unemployment rate. So the lighter one is what they thought it was, and the darker one was what it actually turned out to be. As you can see here, from 1969 all the way up to 2023, and they don't have this data yet, they do a horrible job of trying to predict unemployment, for lack of better purposes. So when you see things from the Fed regarding unemployment, especially in an inflationary environment that we're dealing with now, you have to take all that with a grain of salt. So now we're going to slide over to the fun part. Like I said, I have not shared with you the update with the simulation training, and I want to share that with you. And then we're going to wrap up what I'm looking at from a stock standpoint. And since I'm filming this after the markets close, I'm going to tell you what I did with CrowdStrike for those who followed me last week when I was talking about look for that to be a death cross. So once again, I'm going to give my mouse an opportunity to adjust. We should be adjusted by now. Okay. So for those of you who have been following me, you know this is just simulation trading. This is fake money. I do kind of use this as an experimental platform to how I trade larger accounts and larger sums of money. But this is not representation of my actual account. This is fake money. So having said that, this account I set up for those of you who follow me back in March. And I think we started with $200,000, which is what the fake money starts with. So in 5 months, I have this thing at $310,000, almost $311,000. So if you average that out over a 5 months period, that's $22,000 a month. And if I was to maintain that rate of return, so to speak, or dollar amount, let's just say dollar amount, that's a little bit over $260,000 a year. Now, so for those of you who say, hey, Kevin, you've been doing this for a while and I don't have time to sit in front of a screen all day, that is a big, big misconception. First of all, I do have a daytime job and I do not trade. I'm not a day trader, so to speak. I'm a swing trader. But more importantly, let me show you something that will really, really, really put things in perspective. You see over here to the right, ladies and gents, I said view transactions. I'm going to go by, this is displaying last 90 days. So as you can see here, I've only made 5 trades in 90 days. Now, excluding holidays, the market's open 5 days a week, 20 trading days in a month. So there's 60 trading days on average over a 3-month time period. So in those 60 days, I made 9 trades. So that comes out to be, what, 6 times 8 is 48 or whatever. So like, I'm not even making a trade a week. It's like every 9 days or so, roughly, or whatever, I'm making a trade. This is what makes this so powerful. This is why I keep telling people they need to learn how to do this. There's a lot of books. There's a lot of YouTube information. There's a lot of coaching programs out of there that are really, really cheap. Some of them you can get for $30 or $40 per month. You don't have to sign a long-term contract, but I think it's imperative to acquire the skill because it's one of the last Mohicans that the institutional investors, the pensions, all the hedge funds, everybody makes their money in the stock market. So they're less likely to intervene and mess with that opposed to real estate and all these other things that the middle class have used historically to create wealth. All of that stuff is under attack, with rent controls and rent rights and landlords, being sued for any little thing. So it's just an interesting thing. But I just wanted to share this with you because we have not talked about this in a long time. And I just want to give you an update. $111,000 generated in 5 months. And I don't even trade this account one time a week. So there's no excuse for somebody to come out and say, I don't have the time. It's also a matter of how bad you want to do something. So that, without further ado, because I don't want this video to get too long, we're going to go with talk about CrowdStrike and Tesla. And we're going to call it a day. Let's see here. Give my mouse the time to adjust. All right. So CrowdStrike closed at 246 today. Those of you who've been following me know last week I talked about CrowdStrike. That was on my watch list. And that was on August 30th on Friday. And I explained to you at that point in time, CrowdStrike was at, let's see, go a little bit up here. It's about 276, let's say. It was at 276 last Friday. And I said, I think this thing is headed towards a death cross. For those of you who were with me last week, I'll give you a quick recap. For those who don't know what a death cross is, as it applies to a stock market pattern, just do a quick Google search and you'll find out. The top line here is the 50-day moving average. And the green line here is the 200-day moving average. And I said last Friday, there's a good chance that this yellow line, AKA 50-day moving average, would go below the green line. If that happened, you would have what's called a death cross. And normally when that happens, the stock goes down quite a bit. So at the time I made that on my hot watch list, and it was at 275, as you can see here at the bottom right, it closed at 246. That's almost $30 below where it was last Friday. So for those of you who followed my watch list, I'm not telling you what to do, you do your own research. This is not financial advice. If hypothetically you took out a put option, which is a bearish, a negative bet that the stock's going to go down, and you took that out for at least 7 or 14 days or 15 days, I haven't looked at the option chain, you made thousands and thousands of dollars just in 7 days, just off that one trade. So once again, here's a clear example. That's why I give transparency. For those of you who follow me on Facebook, I show my losses and my wins. But this is something, if you go back and watch last week's video, I clearly said, hey, you need to watch this one. This one looks like it's going towards a death cross. And if so, it's going to go down quite a bit. It's all date time stamp based on last week's video. So I closed that trade out today. I jumped in it and got back out. It was like a 10% trade. And I wasn't even in the trade 5 minutes. I got in it like 10 minutes before the market closed. And before the market closed out, I just closed it out because I was already up 10%. Once again, I'm just clicking buttons. But what do I know? This is what I'm also looking at. I think it's going to be choppy for a bit. I think Tesla has some room once the tech stocks start to stabilize themselves, which hopefully will be in the next 2 weeks, within 2 weeks. So what you have here is that tech stocks have been getting hammered really, really hard, but the dollar is turning down. This is generally good for tech stocks because in a weak dollar environment, tech stocks do good, like Tesla, Apple, Amazon, things of that nature. But there's a lot of volatility right now, and the NASDAQ, aka the tech industry, is undergoing a massive pull down, a drawdown. Hopefully within the next 8 to 14 days, around the latter half of September, running up into the election, this should start to stabilize. And Tesla, I think, has a realistic chance by the end of the year being around a 250 or 260 stock. I will keep you guys updated on what I'm doing regarding that, but this is on my intermediate watch list in terms of something that I might put a heavy amount of money on before the end of September, because I think it has a lot of upside, especially if the dollar continues to go down and the Qs start to stabilize themselves and start to retrench or regain some of the losses that it experienced this week. So wanted to share that information with you. This one's a little bit longer in the tooth. I appreciate you guys watching the video. Once again, I hope you've got some really good information. I tried to slow down a little bit more so you guys understand what I'm saying. I know I have a habit to kind of talk quickly at times. So I hope you got some good information about the rate cuts. If you need to refinance, you may have an opportunity to do that in 2025 and beyond. You're going to get a little relief with credit card interest rates, but we're still dealing with, for those who have a higher level of macroeconomics, the bull steepener is still alive and well, which basically means that the short-term rates are falling at a much faster pace than the long-term rates. And that's the bull steepener, and that's also another indication that we're going to have a nasty recession. So this is going to do it for the Kevin Strong Show. Consider subscribing, like, and if you have a comment to make, drop it below and I'll make sure to respond to it. You guys have a great day and thanks for watching. I'll see you in the next one.